Trying to get my question in. The first thing I like to ask is how many people have seen the candlestick presentations before, so I know how fast or slow to go on the analysis of each one. All right, looks like most everybody. All right, so that means we can go to the next level pretty quick. So the concept of candlestick analysis is basically that the Japanese rice traders have produced signals and patterns that tell us when we have a high probability chance of a reversal occurring in a price trend. But we also can take that one step further and say, all right, if we've got a price trend reversal, what's our next target? And that becomes important for two reasons. One, is the trade that we're looking at worthwhile? I mean, obviously, if you've got a chart pattern that is just about ready to reverse or is reversing, what's the upside potential? Is it 4% or is it 40%? Obviously, we want to look at the one that has a 40% upside potential. And then the next reason we want to know what our target is once we get to that potential target, then we want to start seeing if there's any reversal signals at that area. So we're going to be watching a little bit more closely what happens when it gets to our target area. So when we're analyzing a trend, it's a very simple process using the graphics of candlesticks. One, we want to see what the signals are occurring. Two, if there's any patterns, where we are with our stochastics. Now, obviously, a candlestick buy signal in the overbought condition doesn't mean very much, whereas a candlestick sell signal in the oversold area doesn't mean very much. We want to see a candlestick buy signal in the oversold area, or we want to see a candlestick sell signal in the overbought area. Once we have seen our reversals, now we can analyze visually, instantly, realistically, where's our next target? Is it the trend lines and the moving averages? Usually the moving averages are our big target area. And since we know what our 12 major signals are, and I won't go through them because we'll be talking about them, we can see what's happening in investor sentiment or what our patterns are. There's about 7, 8 candlestick patterns that definitely show high probability, not only reversals, but high probability price moves. So on our charts, which you've seen is relatively simple, we have the 200, the 50, and the 20-day simple moving average for one easy reason, and that is that every major money or every money manager around the world uses these moving averages to make their decisions about their portfolio. The one that you want to keep an eye on is, yes, this session I think is being recorded. Moving average is the 8 exponential moving average, which we call the T-line. So the more elements that we could put on our chart for analyzing whether reversal has occurred, the higher the probability that reversal has occurred. Not because of any technical analysis, but because of the visual analysis of what signals and patterns have occurred in a that the Japanese rice traders have identified over the last 400 years as being a change of investor sentiment. So the moving averages have truisms. First of all, the moving average acts as support. They'll usually test it to see if it's going to act as resistance. So if we've had a uptrending channel going on and they break through the obvious support level, they'll usually come back up and test it. Now we have an advantage because we can see when the downtrend is over where our buy signals are, and if we see buy signals, where do you think our next target is? Coming back up to test to see if that level is going to act as resistance. We also have the visual capabilities of seeing whether it's going to act as resistance because we know the nature of these type of signals once we get here. Kind of a little doji, a little shooting star doji. These are all indecisive trading days. And then we see that it fails. What's that tell us about this trend? It's over. Where's our next likely target? Could be all the way back down here to the 200. However, Notice what happened when it got to the 20. We had a bullish harami. So if we know our basic candlestick signals and what those patterns look like and what they represent, we know a bullish harami tells us that the selling has stopped. What is the blue line? The blue line, this is the 50-day simple moving average. The red line is the 200-day simple moving average, and this gray line is the 20-day simple moving average. Again, these are what everybody uses, or what all the major money managers around the world use to make their decisions about their portfolios. The black line is what we call the T line, and it has a very simple concept. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. And there's a caveat to that, which I'll get to. So once we see a bullish harami supporting right on the 20, and they're starting to take it back up, what's that tell us about the 50? Well, we'll see what happens when it gets to the 50. And once through the 50, the second time, now what's it act like? Comes back and act as support. And what do we have on this pullback? Another bullish harami, which tells us the selling has stopped. We know that our uptrend is in progress. Let's see, the bullish harami is followed by a doji that has served as, I can't tell what that word is a very popular signal. All right. The one thing I hope to learn is what I need to do to trade options. All right. The option trading is based upon what the stock or the market trends are doing. So we'll get to that. So there we see a bullish harami after they've supported on the 50. What's that tell us right away? We can be buying on positive trading because that tells us they've pulled back and the 50 is going to act as support. So if we're buying down here and we can see that every time it goes through a moving average, it comes back and acts as support, we know what our next target is, the next major moving average. And what do we do once it gets there? It becomes much more easy to identify that when we see a shooting star and stochastics start rolling over, what's that tell us about the 200? That they failed, we're probably coming back to the 50. Next time they bring it back up, what type of candle do we have once we got to the 200? Now we started seeing failure here, but notice what they couldn't do at this point. They couldn't close it below the T line. So as long as it stays above the T line, you stay long. And there's another thing about the T line. You close it out. If it closes below the T line, you can always buy back when it comes back up above the T line. Trader Joe, I'm pretty sure you will get a copy of this. So one of these patterns is what we call the blue ice failure. And as we can see, the 50 was acting as support. This was named by my late friend Dave Elliott of Wall Street Teachers, which described a blue ice failure that when they fail a support level, we come down, we can start seeing the candlestick buy signals. They come up and test the where they fell through, and if they fail, they've drowned, and they're going to the bottom of the pond. Now, I always got greatly endeared by David when we did sessions around the nation. I would always say, how do you catch a polar bear? Well, you cut a big hole in the ice, and then you take a can of peas, and you spread that can of peas around the hole. And when the polar bear comes down to take a pea, you kick him in the ice hole. It wasn't a real technical analysis, but everybody remembered what the blue ice failure was. So notice what happened once it pulled back. Look what happened right here. A big, huge doji. And your morning star signal, what becomes our next target? The 50-day moving average. So the candlestick signals basically tell you when or where the high probability trades are going to start. Do you have a stop loss if that's what it would be? Yes. Just to regress a little bit, that if the candlestick signals tell you when there's a high probability of a reversal occurring, for example, This is your morning star signal, one of the 12 major signals. If it opens positive the next day, what's that telling us? That signal, the bulls are in control. But the Japanese rice traders have a very simple analysis. If it opens positive the next day, and this was the candle that told you the bulls were in control, where should it not close? It shouldn't close more than halfway down this candle, because if it did, that tells you the bears are still in control. So this is part of that the sage advice that most money managers gives everybody, which is cut your losses short and let your profits run. And the only problem with that is they never tell you how you cut your losses short and let your profits run. Very simple mechanics based upon what human nature does of when to be in and when to be out of a trade. Can this strategy be used on a 5-minute chart? Yes. Candlesticks are fractal, meaning they work on a 1-minute, 5-minute, 10-minute, 30-minute chart just as well as they do on a daily, weekly, or monthly. Candlestick signals are the accumulative knowledge of everybody buying and selling during a particular time frame. This chart could be a daily chart just as well as it could be a 5-minute chart or an hourly chart. All depends on when you, what time frame you want to be trading. I'm talking about volatility, crush, etc. when underlying goes up but option goes down. Shed light on this and other things. Candlestick, I mean, option trading is just a method for buying the stock. We're trading the underlying stock. So it doesn't matter, or we're not too much concerned that on any given time frame that if a stock's going up and the option isn't, that just means the volume or the trades haven't occurred. Is the speaker showing where the chart is pointing? You should be. Can you see my cursor? What is your win-loss ratio with this strategy? William, I was a stockbroker when I came out of college. In 1975, became a stockbroker with Kidder Peabody, then Cowan and Company, and Oppenheimer for 8 years. And I was the worst investor in the world, and I still wanted to be a stockbroker. And I contributed so much money to the markets, I got out of the business because I realized that the brokerage firms had no more idea what made stock prices go up or down. Their philosophy was find a good company and hold on to it long term. And as we saw in 2008, that wasn't a very good strategy. I got out of the business. I went to Atlanta, Georgia, started buying houses, renovating them, and reselling them. And then somebody dropped candlesticks on my desk. And they said, you were a stockbroker. Take a look at this. Tell me what you think. Well, this was in 1980-something or other. And it sat on my desk for 3 months. He kept badgering me. So finally I picked it up one day and looked at it. And my first thought was, this makes sense. And the more I looked at it, the more sense it made. So I started trading with it. And the first 6 months, I still had my emotions involved. I said, well, this is what I think the stock should, or commodity or whatever I was trading should do. But that's not what the chart is telling me. And what I discovered was the charts were always right. My emotions were usually wrong. So I don't know what my rate of return is, except I make a very, very good living, and I know that every time I put on a trade, the probabilities are in my favor that I'm going to be making money. Now, the other side of that is that term probabilities, that I know that probably 2 out of every 3 trades I make is going to be a positive trade. Now, it might be positive by 0.3%. It might be positive by 300%. So the other side of that is, that most people don't address, is that 1/3 of my trades aren't going to work. It used to be, because I was smarter than everybody else, when I put on a trade, it was because my superior intellect said that stock was going to go up. And when it didn't, it was because people that weren't as smart as me didn't realize why it should be going up. And I would hold on until I, like everybody else, I would finally, the pain was so big, I'd sell out at the bottom. Now I know that when I put on a trade, I can mentally rationalize that 2 out of my 3 trades are going to work. One of them's not going to work, so when it's not working, I can close out that trade immediately and move on to something else. Right now my pointer's not on there. Now my pointer's on there. So at least now I have the wherewithal to say, all right, if I put on a trade, I know the probabilities are in my favor, but I also know when that trade's not working, I close out the trade immediately. So I know that was a long answer to say I make an extremely good living now where I used to be a contributor to the markets, that I constantly pull funds out of the market. Do you prefer trading stocks or options? I've got accounts that I trade stocks in because they're too big to trade options. Then I've got small accounts that I trade basically options. I also trade commodities during the middle part of the day. Like you view. So anyways, yeah, William, part of that analysis of I know that 1/3 of my trades aren't going to work, so that doesn't become a mental issue with me anymore. That tells me that when I put on that trade, this is what should be happening, and when that chart tells me it's not happening, I close it out immediately, not thinking, boy, was I stupid to do that trade. I just know that trade didn't work and I can move on to something else. The charts are always correct because they are showing past history. Nobody has shown me their predictive capabilities. Keep watching, Frank, because that's what this whole point of this is we're not buying or selling based upon fundamentals. Prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals, and that's all candlestick signals are, is the graphic depiction of what's going on in investor sentiment. So if I'm looking at this chart and I'm starting to see buy signals, where's my next target? Up here at the 50-day moving average. What do I want to see at the 50-day moving average? I want to see that it gets through. When I can see that at the target there was a big shooting star signal, I know that's time to take profits. Why is that telling me it's time to take profits? Number one, because I have a sell signal in the overbought condition. And number two, what was my overall direction of this trend prior to that move back up to a resistance level? It was in a downward move. So when it bounced, I saw a sell signal. Now I know where my next target probably is. Back to the bottom of that trend. Answer questions at the end. Okay, I can do that. So anyways, I'm looking at something that tells me what are my probabilities. I'm in an overbought condition and I see a sell signal at a major resistance level. If I bought here, I'm selling here. Am I trying to buy at the absolute bottom and sell at the absolute top? Definitely not. I'm trying to find make my correct trade ratio extremely high with positive trades. I'm not trying to eke out every profit on this trade. I'm trying to stay with a high probability part of that trade. So moving averages act well because they act as magnets. Why is that? Because if you're a major money manager and you like this stock and you decide you're going to buy, and usually money managers are going to come in for big volume and it's drifting back, where do you think you're going to wait until to see if it supports? You're going to wait to see if it supports here at the 50-day moving average. What do we see once it gets back here? We see a morning star signal right on the target with stochastics in the oversold area. We're starting to buy on positive trading above the T-line and breaking out through this level, because what did this tell us right here? This told us this was the area where the money was starting to come in and buy with a high probability. What was our sell signal? If we were buying based upon a buy signal at a major support level and it started trading above the T-line, we didn't want to see it close back below the T-line. My stochastics are set at 12.33, and that's nothing set in stone except one night I sat and said, all right, where do my stochastics show at the peak, and where do they show the bottom at the valley? And when I started way back then, the assumed stochastics was 14.55. Well, I'm a swing trader, meaning my trades last anywhere from 2 to 10 trading days, and 1233 seemed to work well, whether I was trading stocks, bonds, currencies, commodities. So anyways, this is where we buy. So what type of pattern are we looking at? Well, this, as you can see, was what we call a fry pan bottom, which is one of those strong price patterns that when it breaks out, we've got a very strong price move. Now, remember before, I said you stay long as you see a candlestick, don't see a candlestick sell signal and a close back below the T line. However, there's a caveat to that, which is the further away you move from the T line, like any moving average, the higher the probability it's going to come back and test the T line. Now, the T line is very important in the sense that everybody has the 200, the 50, and the 20-day moving average on their charts, but nobody has the T line. So remember when we said the price movement acts, or the moving averages act like magnets? Well, the T line, since nobody has it on their charts except very few people, is more of a Fibonacci type support and resistance. That's where human nature usually brings a price move. So if you take the concept of a Fibonacci natural support and resistance of human nature, and you take the graphic depiction of investor sentiment, when you combine those two, you've got a very powerful combination that tells you what normally happens in a price move. Let me go through this. I'll try to, I can stay as long as possible, so if I'll go back and catch everybody's questions. So if it looks like I'm ignoring them, I'm not. So again, if we can utilize the information and build in the candlestick signals and then add the other indicators, it gives us a much higher degree of probability. Remember what our trend analysis is? If we see a candlestick buy signal, we can stay long until we see a candlestick sell signal and a close back below the T line. Once it closes there, what's our next target? More than likely the 50-day moving average. Once it gets there and fails at the 50, where's our next target? The 200-day moving average. If we start seeing buy signals at that point, what's our next target? They're going to come back up and test this level. So what are we watching once we get up here? If we had been buying here, what do we want to see when we get to that target? We don't want to see. We want to see whether it's going to go through and continue the uptrend, or whether there's a blue ice failure, which makes our next target down here at the 200-day moving average. Again, this is not rocket science. This is just changing your view of what moves prices, which is human nature. And again, the perception of what's going on in price movements versus trying to analyze what's happening as far as the fundamental reasons that you should be buying. Do you use Fibonacci? I don't use it as a criteria. I use it as a potential target, that if I see a strong uptrend and I see it pulling back, I look to see where it could pull back to, whether it could be the moving averages or is it a Fibonacci number. So I'm not looking for it to move back to those levels. I'm looking back at the pullback and then seeing what level is it reversing. Is it reversing on a trend line, a moving average, a Fibonacci number? So once it fails and then starts back up, where's our next target? Back up to the 50. Why do we watch to see what happens once it gets there? Because if we see a doji in the overbought condition, we know our simple rule of a doji. The price is usually going to move in the direction of how they open it after a doji, which told us they failed up here. Any long positions now should be covered and look and go short again. And when we go short again, we can identify which type of patterns we're seeing. We got a doji telling us the downtrend is starting, but is it going to be another downtrend? Well, this is what we call a doji sandwich, which is a very high probability trade setup. You have a big day, then you have a doji. What's our simple rule of a doji? It's going to move in the direction how they open after a doji. So if it starts trading lower after the doji, we can know our short positions are in good shape because we know this day right here, this candle, and this candle will probably be about the same magnitude. which tells us they're trading back below the T line. And we know it's a high probability that if we are starting short right here, we know pretty much that this candle is going to be the same as this one. Thus, the doji is sandwiched in between these two. Now what becomes our next target? Well, there's no moving averages down here, but we can see there's kind of a support level right at this level, so we just watch to see what happens once it gets to that support level. Once it did, we're starting to see dojis in the oversold area. We can start now watching to see if they're going to take it back up. So the T line, the red line is the 200 ICE. The blue line is the 50-day moving average. Is this only working on daily bars? No. Any chart that we look at could be any time frame. This could be a 5-minute chart. It could be an hourly chart, all depending on what you want to be watching. The stochastics are 1233. This is what I use. So once I see that breakdown, where's my next target? The 50. If I was short and I saw a bullish harami, I'm probably covering my short position to see if it's going to get back up above the T line. When it doesn't, I can stay short till it gets to the next target, the 200. There's a hammer signal. What's that tell me? Well, if we're in the oversold area and they open up positive the next day, where do you think your next target is going to be? At least back up to the T line. The failure tells us I can stay short until I see a candlestick buy signal and a close back up above the T line. So again, the T line has truisms. The further away you move from the T line, the higher the probability it's going to come back down and test that level. So what do we do knowing that we've moved that far away from the T line? Well, number one, I forgot to tell you the first premise of candlestick analysis, which is the Japanese rice traders tell us, where do most people sell? They panic sell at the bottom. Where do most people buy? They buy exuberantly at the top. So if we know that, again, this used to be me. I was usually buying here because everything was great. It's been going up. It's going to go up further. And as soon as I'd buy, it'd turn around and go the other way. And I could never figure out, how come when I buy, it always heads down? Or how come when everything's so terrible and I sell, it immediately turns around and starts heading up? So if I know my number one criteria, which is most people buy at the top, and look how far away we've moved from the T line, it makes it very simple. That if I'm long and I see that there's exuberant buying going on because they've moved that far away from the T line, then I flip to my 10-minute chart and see what the 10-minute chart is telling me. And as soon as I see a candlestick sell signal and a close below the T line on the 10-minute chart, I start taking profits, because where's my next likely target? Back down here. So if I've got profits up here, I definitely don't want to wait to see if they're going to take it all the way back down to this level. Again, the further away we move from the T line, the higher the probability it's going to come back and test it. I could always buy back on a positive candlestick signal, but that was my first major buy signal and a close above the T line. The T line is the 8 exponential moving average. When you get a candlestick buy signal, do you enter on that time, or do you wait for? If I'm that far away, if I'm right here on the T line, or right here at the T line, I'm buying as soon as it closes above the T line, or trading above the T line. If it's, let's say this price had moved all the way down here and the T line was up here and I saw a buy signal, my number one criteria for buying or selling is the candlestick signal, being in the right condition of the stochastics. So the confirmation is the T line. But remember, the signals are your number one criteria. So if I saw a buy signal down here, way below the T line, where do you think my first target is going to be? Coming back up to at least test the T line. The T line is short for trigger line. We tried to figure out a short name for it, so we weren't always explaining what it was. But so it was trigger line. We just called it the T line. Does the whole body have to close below or above or just the wick? No, the wick is not a close. Remember, a candlestick signal is based upon the open and close. Those are, to the Japanese rice traders, those are the two major important decisions each day or each time frame. Where did they open it and where did they close it? The wick is just the range that it traded. So we usually wait for the close, because when we say it needs to close above the T line, that was the final decision, and that told us where they were closing it based upon whatever technical level we were looking at. So I guess I better. So for new folks, a bullish candle is when they open it here and close it above where they open it. That causes a green candle. A bearish candle is when they open it here and close it below where they opened it. Now, that doesn't necessarily mean that you're up or down on the day. Sometimes they gap it up and close lower, creating a dark candle, but it was still up for the day. But it tells you immediately what was going on at those levels. So if we know what our patterns are telling us, but we know a J-hook pattern tells us that at wave 1 and wave 3 will usually be equivalent. So even if we've missed this move, and we see our J-hook pattern, and notice what they couldn't do on this pullback. They couldn't close it below the T-line. And what did it start doing? Coming back up. So I have no qualms about selling here, knowing it's going to come back and test the T-line. I don't know whether they get to the T-line or whether they're going to keep right on going. Why take the risk? I know at least they're coming back to the T-line, and then I can always be buying back here. I don't mind selling here and buying back here. Now, back before candlesticks came along, if I own this and I got out, I'd tell myself, they're not going to trick me about getting back in and then taking it back down again. Now at least I know what the patterns are telling me, what human nature usually does. So when the profit taking's over, even if I missed wave 1 and I can see a J-hook pattern set up, I know what the magnitude of this move should be. When I'm trading commodities, I'm usually trading off the 10-minute chart, and then I flip down to the 5-minute and 1-minute chart for my entries. So the moving averages are basically the grids of the playing field. This tells me when it's time to buy. This tells me when it's time to sell. This tells me it's time to start buying back, because notice what they're doing. This is what we call the T-line crunch. They couldn't close below the T-line. So even if we sold out here at the first resistance, we can be buying back once the T-line told us that they weren't closing below the T-line. And when they crunch it back up through this resistance level, where do you think your next target's going to be? The next resistance level. And when it got up here, notice what it did. Where do most people buy? They buy exuberantly at the top. So if I see a gap up in the overbought condition, that's exuberance. Very simple rule. If you see a gap up in the oversold condition, start watching for a sell signal. And if they do it right at a major resistance level, the probabilities are pretty strong that they're going to come back and test the T-line. And when they do, that's what we call a bobble. Comes up, fails at the resistance level, they come back, they can't close below the T-line, they kind of bobble it around in here. We can always be selling and always be buying back when they come up through that resistance level. Again, I'm not trying to get every profitable penny by buying at the absolute bottom and selling at the absolute top. I'm trying to make sure that every trade I make are heading in the right direction so that my compounding effect is much greater and my risk factor is much lower, knowing that I'm buying based upon what the chart is telling me, and when it gets up to a resistance level or a risk area, I'm taking profits. I don't need to be, I can move on to the next trade. Again, the bobble is when it resists, pulls back, can't close below the T-line. We're buying when it breaks out through that level, because what's our next target? Up here at the 200-day moving average. Does every trade go right to the moving average? Obviously not. But the one thing I tell people about candlestick signals is it puts you in positions where the probabilities are in your favor that it's going to the next target, whether it gets there in 1 day or in 3 weeks. At least you know you're in the right direction at the right time. And again, this could be a trade based on a 1-minute chart. In this case, I trade soybeans. Same scenario. Had the bobble. Where was the next target? Up here at the 200. This is off the 10-minute chart. And I'm usually basing what's happening on the 10-minute chart based upon what's happening on the daily chart. So when you use candlestick signals and moving averages, you dramatically improve your trend analysis. That if we know right here, and this is kind of what I show our trading rooms, that this is not a reversal signal. This is not one of the 12 major signals. This is just an up day and a downtrend. So that usually tells me this trend isn't going to be as strong. Now this right here becomes a much stronger signal because now we have a doji gap up in the oversold area. That's known as your best friend. That usually creates a very high probability upward move. But notice what happened once it got up here to the resistance level. There was a bearish harami and they started selling it off. Things rolled over. That told us we wanted to be out of this trade. Where was our next likely target? Back down here, or possibly even lower. But all this was a sideways move. Why aren't RSI type indicators trades? Because stochastics have worked extremely well, and it's a very simple concept that the Japanese rice traders say: if you're in an oversold condition and see a buy signal, the probabilities are pretty strong you're in an uptrend. If you see a candlestick sell signal in the overbought area, you're probably in a downtrend. So you can analyze the trend of the market based upon the signals. There's an uptrend with an evening star signal in the Dow and a close below the T line. Where's their first target? Seeing whether it supports here. But notice once it hit the 50, they could never get above the T line. Where's the next target? The 200. What do we have down here? There's a very strong morning star signal. Somebody was asking me a while back, how many days does it take for your reversal to occur to tell you there's actually been a reversal? And then with candlesticks, the answer is 0. If you see a candlestick potential reversal signal, especially right smack dab on a major support level, and your stochastics are in the oversold area, and we know our simple rule of a doji, that they're going to move in the direction how they open after a doji, we're buying immediately because we know the probabilities are there's been a reversal. And then when it closes above the T line, we know how long to hold this trend until you see a candlestick sell signal and a close back below the T line. So why are the 200 and the 50 moving averages important versus RSI? Because every money manager around the world uses the 200 and the 50 to make decisions about their portfolio. The green line is what we call the 3T line. And the 3T line is just kind of a bullish confirmation or a confirmation of a trend reversal if it comes back up through the T line. And it's also very effective that the further away you move from the T line, the higher the probabilities that the 3T line now becomes more important, that a failure of that level tells you they're coming back to test the T line. Just a quicker entry and exit strategy process. You go to the weekly or monthly to confirm before you buy on a daily chart. You can. Yes, and we got people in our chat room that use when they're getting ready to buy, they take a look at the weeklies to see if the weeklies are also being confirmed. So the 3T line is the 3 exponential moving average. Remember, this is the 20 simple, the 50 simple, and the 200-day simple moving average. The 8 exponential is the T line, and the 3T line is the 3 exponential moving average. So what is the number of intervals in, it's the 3-day moving average. So this is where analysis is much easier, knowing what type of different say chart analysis is. When we see this start happening, and we know that we probably have a trend channel in progress, and they fail up here and close below the T line, if we could draw a line through the tops, where do we think our next target is? Draw a parallel line, and that's probably going to get you pretty close to where the bottom is. And once we get down here and we start seeing doji, hammer, doji, bullish confirmation, and they start trading above the T line, where do you think our next target is? At the top of the trend channel. Is it going to get there? Have no idea, but our criteria will be we're staying long until we see a candlestick sell signal. And once we got up to that, basically that level, started seeing selling, where's our next target? Back here to the T line. So if we're starting to take profits in here, then we just watch to see what it does. We know it's going to come back here. So if we're adding short positions, we know that's being confirmed when they can't stay above the T line. And what happens once it gets to the bottom of the trend channel? A big morning star signal, not only at the bottom of the trend channel, but notice what the doji did. Traded smack dab to the 200-day moving average before showing an indecisive reversal signal. And so that tells us we're starting to take profits down here, because notice how far away we've moved from the T line and got to a support level. The probabilities with stochastics in the oversold area said that's where there's going to be a reversal. Where's our next target? We'll see what happens once it gets back up to the top of the trend channel. So we can identify when reversals occur. Here's our morning star signal. And then notice what follows it. There's our doji sandwich. We call this a McMuffin because if you took a morning star signal and a doji sandwich, or a morning sandwich, it becomes your McMuffin. Then once we get to a resistance level, what do we know about the doji? It's going to move in the direction of how they open it after. So if we're up here getting ready to take profits, and they open up positive the next day, what do we know about the doji? They're going to move it in the direction of how they open it after a doji. We know we've got a doji sandwich telling us the 50 is not acting as resistance anymore. Their uptrend is in progress. This is just simple analysis based upon what we know, what each signal and pattern should be doing or after each one. So back to somebody's question of the charts don't tell us anything. It doesn't tell us how to interpret the future. We know a reversal signal in the morning signal is a high probability reversal signal. We know a doji sandwich has a high probability that there's going to be follow through. So you combine that, we know there's a high probability your uptrend is in progress. Yes, I use a trailing stop mostly when I get up to the overbought condition. Very simple rule that if you're in an overbought condition in an uptrend, where's the likely place that the sellers have now taken control? And that's just putting a stop at the previous day's open, that if there's enough strength to come back down through that level, you want to be out of the trade. That's the sellers taking control. I'd say, isn't investment managers' decisions reflected in the volume? No, not necessarily in volume. A lot of people say, I want to see the volume increasing as the price goes up. Volume and price have absolutely nothing to do with each other. If nobody's willing to sell the stock and people are willing to buy it, that price can go up on very low volume. The only time that volume becomes a big issue is if on this day we see a huge volume, and I don't have volume on here, see a huge volume spike, basically it adds confirmation. There's been a major change of investor ownership of that stock. Get ready for a reversal. So I'll go back to what I stated in the beginning when I first looked at candlesticks. The patterns and the signals were merely just common sense put into graphic depiction. And I always tell people, a lot of people say, well, how do I teach my kids how to invest? The first thing is you don't listen to the Wall Street rhetoric. If something on Wall Street is not working, it disappears very quickly. Candlestick signals have been around for 400 years. The Japanese race traders that used it didn't become wealthy in Japan. They became legendarily wealthy. They were the financial powerhouse for centuries. And it was all based on one simple premise, that there's one indicator that works consistently time after time. and that's human nature. So if you always keep in mind that prices do not move based upon fundamentals, prices move based upon the perception of fundamentals, you're going to be way ahead when analyzing charts. And again, the analysis of a candlestick chart is not difficult. It's basically visual. What type of signals? Where's my support and resistance? This is what we call the classic. The classic is we know what should come out of a fry pan bottom. A fry pan bottom is this big rounding bottom pattern that you couldn't trade one way or the other if you wanted to. But notice what happened when it got back up to this level. They started breaking it out. So even on this little fry pan bottom, if you started buying, you knew you were in an uptrend until you got to this resistance level, and you could see what happened when it got there. We know what to expect coming out of a fry pan bottom, a very strong price move. We also know what to expect out of a J-hook pattern. The prerequisite is a very strong price move. Then it pulls back, and then starts trading indecisively and starts back up again, the profit taking it over. So even if we miss this move, we can catch this move because we know wave 1 and wave 3 will probably be equivalent. Do you use a percent trailing stop? No. The trailing stop is based upon what on the chart would tell me that the bears are now in control versus the bulls. There's so many money managers that say, oh, you should put your stop at a 3% pullback, a 5%, at 8%. The one thing that, or a lot of people tell you to put a stop loss if you're down 3%, 5%, 8%, 10%. One thing about the market doesn't give a hoot where you bought. The market is going to move the way it's going to move no matter what. All we're looking for is when is that market move starting to move positive. And so if it's moving positive and we see that bearish engulfing signal at the 50, what's that tell us about this level? That's going to be a resistance level. What's our trend telling us? We're in a downtrend. Where's our next likely target? Back down to the bottom of that trend channel. We traded WIN a while back. Got up here, started taking profits. When was the next time to buy? When they could close back up above the resistance level. They didn't until down here. We had a bullish engulfing signal followed by a gap up through the resistance level, the 50. That's when we were buying. On the other hand, we were buying Bobble at the same time because it did an inverted hammer, one of your high probability reversals, and a close above the T-line. Where was the next target? Up here at the 50. What did it do when it got to the 50? Did a doji. What's it telling us? That they were trading above the 50, and what happened then? The 50 was now acting as support, trading back up. Where was it going to move to? It's probably going to move up here to the 200. When it went through the 200, where was it going to probably pull back to see if the 200 was going to act as resistance? So it also allows us to, with simple target information, when to take profits. We're buying down here because we have a left-right combo, and it gaps up through this downtrending channel above the T-line. What's our first target? Obvious, the 50-day moving average. So if we're buying right here, we're watching to see what it does here. That's our first target. When it goes through, what's it telling us about our first target? That it's not going to be a resistance. So where's our next target? Well, there's a gap up here. It could be our upside potential. Or now I can throw the Fibonacci numbers on here. Are these my targets? No. Right now my target is I'm going to stay long until I see a candlestick sell signal. And if that candlestick sell signal happens here or here or here, that's a pretty much good indication that's where the reversal is going to occur. I'm taking profits right here because what do I have? Overbought condition. I've moved away from the T-line, taking my profits. Where am I buying back? Well, I can obviously see, notice what it did on this hammer day. Came right down to the 50 to see if it's going to act as support, and it did. we're buying back here. So when we're selling out here, because we're that far away from the T-line, we know what our next target probably is, the T-line. Is it going to support there? We have no idea. For all we know, it could head right on down here to where it was before. We're buying back here because now what type of pattern do we have setting up? A J-hook pattern. Where's our next likely target? Eventually up to the 200-day moving average. Apple, we're buying down here. What's our target? The 200. When it hits the 200 and we start seeing selling, what now becomes our next target? Down here at the 50. It didn't hold there. Or if we can see there's a trend channel and we start seeing sell signals, where do we think our next target is going to be? Notice our stochastics are rolling over after a sell signal, an evening star type signal. Where's our next target? This support level and or the 200. However, when we see that bullish engulfing signal right here on the 50, and they start confirming and telling us the stochastics aren't heading down, what's that tell us about our resistance level? That if it goes through here, we stay long, as long as we don't see a sell signal and a close below the T-line. So if we're buying, this is one of the patterns that we show our chat room. Now, in our chat room, we've got usually about 200 people in there each day. We've got an options trading room, but we're looking for the high probability patterns, and this is what we call the slow curve. You can see how there's a very slow curve. And remember, we just went through a whole process saying we want to buy when we see a buy signal in the oversold area. But on a pattern, there's a different perspective. Where are patterns usually going to break out? When you're already in the overbought condition. And when they do break out of these high profit patterns, like a slow curve, what usually happens? They're usually big price moves. And where's our next target? Up to the next major resistance level. That's where we're taking profits. So there's our doji sandwich again after a sell signal. And they gap it down. Where do you think our next target is going to be? Down here to the 50-day moving average. Why? Because moving averages act like magnets. The T-line, the 3T line, notice how the 3T line was getting far away from the T-line, and when we started seeing a sell signal, that told us, especially when they brought the 3T line down through the T-line on a candlestick sell signal, that told us now the probabilities are pretty strong. We're heading in a downward direction. Stochastics are 1233. Is there any way to tell the stock might gap down before it happens? No, other than the fact that a lot of stocks, if we're right here and we've seen a sell signal, it's probably influenced also by the market itself. And the next day we wake up and we see that the pre-market futures are down 100 points on the Dow. We can usually see where they're going to open this, where the bid-ask is. That if it opens lower, and especially gapping down, we're shorting immediately because that's exactly what we would expect coming after a sell signal. There's that slow curve. And where did it break out? Right here at the Bobble. Made very good profits in this one. Not because we picked out we were good stock pickers, because this pattern told us that if they broke up through the 50 the second time on this T-line crunch, we were in an uptrend. Did we expect it to move this fast? Definitely not. We just knew that we were in the right place at the right time. On the other hand, at the same time, MNK, which we had been buying down here, started seeing sell signals. We closed out the trade, and we were ready to come back in had it broke out through this level. Because what would this have been if they opened positive and started trading positive? There was your bullish doji sandwich in progress. And if that was your first candle, and they opened up positive, and that candle was the same magnitude, what did it tell us about our resistance level? That it wasn't resisting anymore. What type of pattern did we have then? We had a J-hook pattern that told us wave 1 and wave 3 were going to be the same. But notice what happened. They opened it lower and traded it lower. Now what did it tell us about this level? That this was probably a double top. We didn't want to be in that trade. Scotty, a while back, here, hit the bobble, came back up through, came up through the, here we're buying again, because what happens, what's our next target? Coming up here to the 200. So gaps basically improve your projection of where a price might move to, because gaps get filled. As we saw not too long ago, we started shorting things in the market because here was our analysis. There was a trend channel. And what happened when they got back to the top of the trend channel? A bearish harami. What did that tell us? The buying had stopped. So we're shorting because where do we think our next target's going to be? Right here at the bottom of the trend channel. At that point, if we see buying, we'll cover it. In this case, they went through it. Where was our next target? Everybody says gaps eventually get filled, which they usually do. So a lot of times when we're buying here, say because of the gap up in the oversold area, people say, well, isn't this gap going to get filled? Yes, it might in 2 days, 2 weeks, 2 months, 2 years. We're trading this trade right now versus when they're going to fill this gap. So when they started pulling back the Dow, where was the likely target? Coming back down here to fill that gap. And the reason was because we happened to be in the right place at the right time, because that told us that the buying had stopped. We'll start watching for it to go to the sell area. So we started shorting. It was the biotechs that were getting hit pretty bad. But notice what we had here, a little kicker type signal at the resistance level. Where was our first target? The support level. Where's our next target? Here, and I think it even went down through that level. This was a few days ago. But so we were getting in the oversold area at this point. If they opened it positive, what was it telling us? That they've had a doji in the oversold area and they're that far away from the T line. In this case, I think they even opened it lower. It did open lower, and as a matter of fact, we just covered that trade PBYI today because of the reversal. Another case, left-right combo, closed below the T line. What did that tell us? There's wave 1, there's wave 2. There's our first target, the support level, and if they broke through that, what did that tell us about this wave? This wave and this wave were going to be approximately the same. Shorted RLYP, left-right combo, right here at the 200. They started gapping it down. We're shorting right here. Because if we see a left-right combo and they start gapping it down, we're going to stay short until we see a candlestick buy signal and a close above the T line. Another one that is starting to roll over, or was starting to roll over. We made our entry strategy that if it came back down through this level, that told us that this dumpling top, which is the opposite of a fry pan bottom, was in progress. We were looking at CEQP. We had made some good profits on this one. We sold it here when it hit this level. We were looking for the Bobble, which meant if it opened positive and started trading positive, we had the next wave in progress. However, when it opened, even if we had bought it here, and we didn't have time to because it immediately started trading off, makes it very simple. If it opens and then starts trading lower, we're not buying, but we can put our buy stop at where it opened, because if it came down and then came back up, it was confirming our pattern. In this case, even if we had bought on this day, it told us with a left-right combo at the resistance level, we should be out of that trade immediately. Another one that we shorted, and these are all a few days old. These were all shorts just based upon the market rolling over, and we were seeing sell signals. So we made some very good profits because we covered most of them today, and I'll show you why on the daily chart here in a minute on the Dow. But there was a morning star signal. And notice how far away we were from the T line. So on that morning star signal, we started covering some short positions, but we re-entered the short positions because what did it do? Got up to the T line and failed, and then came back down through the bottom of the candle that told us the bulls were in control. Even though we had covered some shorts, we re-shorted, because told us they weren't coming up above the T-line. They were still heading down. This was the Dow today. We had a big hammer type signal. Now, when did we start covering our short positions? A lot of shorts gapped open to the downside. And where do most people sell? They sell exuberantly or panic sell at the bottom. So where did our logical stop become? Once they gapped down and started trading lower, we just put our stop at where it opened, because the logic was if it came back up through the open in the oversold condition after gapping down, the probabilities are pretty strong it was going to create some sort of candlestick buy signal. And we started taking profits in some of our positions, because notice what happened when the Dow got down here. Where do most people sell? At one point, the Dow was down 500 points today. And what did it tell us at this level? That we were a good fur piece away from the T-line. That we started watching our 10-minute chart and started taking profits. Why? Because we were way in the oversold area. This was the NASDAQ a few days ago. Had the possibility of bouncing back up. This was the NASDAQ today because it failed at the T-line. And after it being down quite a bit, we started seeing bullish. So the NASDAQ was down today. But notice what the NASDAQ did after it opened. It was, they were trading above where they opened. So somebody could be looking at it and say, oh, the NASDAQ was down. We look at it on the basis they were buying from where they opened it, so there was buying going on today. Marvino, yeah, we have a chat room. We got 200 people in our trading room, and that's a very good place to learn candlesticks very quickly. As a matter of fact, hold on here. I've got some sort of special. I think. Let me get to that. We've got. Let's see, Steve. Do you have the link? Oh, there it is, lower to the right. We've got a projected price targets, a lot more in detail what I did today, for $17. Now, I think it usually trades for $147. So many times in the past, people have said, well, why are you selling your stuff so cheap? Because what I discovered in the past was when I first started learning candlesticks, it made so much sense to me. And as a matter of fact, turning around being the worst trader in the world into taking money out consistently, and this was way back when the first chat rooms started showing up on the internet, I would ask the question, why isn't everybody using candlesticks? They work, I mean, they're just common sense. They work so well. And the answers were, there was too many signals to learn, and they didn't always work. And I always came back to one simple premise, that if they didn't work, we wouldn't be looking at them today. And there are 50 or 60 signals in the candlestick universe, but if you just learn the 12 major signals, not only do you recognize where most of your reversals are going to occur, like most mean 99% or better, and you understand what the psychology was that that created those signals, you now have as much grasp of what moves price movements as somebody that's been trading for 50 years. Lewis, it should be a download if you just did it right now. So anyways, the reason we put out information is because once you see, don't let 3 cups of the same price for 3 cups of Starbucks coffee deter you from learning the logic behind a lot of the information that's built into candlestick signals. Remember, if candlesticks didn't work, we wouldn't be looking at them 400 years later. It's not that they don't work, it's just learning how to learn to use them correctly. The course is, yeah, it's just a video download, yes, so that you have it. So now, again, our chat room, we have 200 people in there on average. We've got another room with 40 or 50 people that trade options only. We're going to be opening that room up to commodity trading also. Lewis, if you're having problems, email Abraham@candlestickforum.com, and he'll get you the link to get you set up. I think, ICE, there's a 30-day free trial. I don't know whether it's part of this deal or not, but if you want to try a 30-day free trial. Now, in our room or on our website, there's about 1,300 pages. Yeah, we got an options trading room. There's about 1,300 pages on how to use candlestick signals correctly. And I put out a 2 or 3 stock picks every day. And I tell people these stock picks are not so that you just have stock picks, so that you can look at the chart, and sometimes I put a 2 or 3 minute video on what the market's doing and those are being picked, because we've discovered if you just tell people what to do and they don't understand what the reason is, you're not teaching them anything. It's like I tell people it's like the cop standing on the street corner and he sees this drunk in his car weaving down the street. He blows his whistle, pulls the guy over, walks up to the car and sees a penguin sitting in the back seat. And he goes, "What the heck are you doing with a penguin in the back seat?" And the drunk said, "Oh, I found him out on the street and I don't know what to do with him." And the cop said, "Well, take him to the zoo." The drunk said, "Oh, that's a good idea. I didn't think of that." Well, the next day, here's the cop standing on the corner. Here comes this drunk weaving down the street again, blows his whistle, pulls the guy over, walks up to the car, and there's the penguin sitting in the back seat. He said, "I thought I told you to take the penguin to the zoo." Drunk said, "I did. He liked it so much today we're going to a baseball game." So if you don't understand why you're doing something, it doesn't really do you any good. So the chat rooms are excellent places to learn what the rationale and what the information is that's built into good charts. We've got a lot of good traders in there. Whether you're a day trader, a swing trader, or a long-term investor, remember the candlestick charts are just the accumulative knowledge of everybody buying and selling during a particular time frame. Wayne, I don't know whether they've given a 30-day free trial. I guess the worst case scenario is email Abraham, if there's not a free trial. I didn't read what was all in our free trial. I know it was a $147 video for $17. I don't know whether they threw the 30-day free trial. If not, does it expire in a year? Lynette, does what expire in a year? Oh, no, the $17 is just for the video. It's a discount price on the video. Our normal monthly membership is $97 a month to the chat room. So for $17, you get the video, and then you might get I think you get a 30-day free trial to the website. How do I buy? Eric, over to the right. Steve, can you put the link in again? There's a link over there that if you click on that link, that will take you to the offer. No, today is just a recording. The video is, I think, it's a longer video. It's probably more detailed than what we went through. It's Abraham@candlestickforum.com. Let me see if I can do this. So with that, if there's any other questions, I'll be glad to answer them. Let's say send all. Okay, there's Abraham's over to the right. All right, any other questions? Let's see, there may have been a few up that I skipped over just because I didn't have time to do them. Anyways, for $17, I mean, I'll go back to what I said before. I was the worst investor in the world. And when you use candlesticks, it's basically just common sense. It's just common sense, and it's graphics. It's basically you can visually see what's going on in investor sentiment, and if you understand what the signals are and where you are in the trend, you've got a much better grasp of where reversals might be occurring and or how long a trend is staying in existence. Okay, Lewis, if you don't hear back from him, yeah, you'll hear back from him. What are the red and blue lines in the stochastics? That's one's fast and one's slow. That's how they're usually just set up. Now, some people trade when the stochastics cross, but that's a that's usually a delay after the reversal signal's already occurred. Oh, Christopher, I forget how long it is. It's at least an hour, I would think. On our website, we've got 40 or 50 videos on how to set your stop losses, how do you set your entry strategies, how to scan for the best trades each day. It shows how you can basically scan. Once you have your scan set up, it takes less than 20 minutes each day to find the best trades for the next day. A lot of patterns require a gap. Some patterns require a gap. The kicker signal is definitely a gap up from the previous day's close, or from the previous day's close back up above the previous day's open and goes the opposite direction. But even if you're trading things like the Forex, where it's a constant flow of trading, it's still going to be there's still enough patterns and signals out there that you can trade off of that. The Harami, well, the Harami is but sometimes on a flowing chart, the Harami might be that it opens right here and then closes up there. It doesn't have to be a gap. Do you have a separate form for Forex? No. Again, remember, candlesticks are not the analysis of any particular trading entity. It's showing you what human nature does no matter what you're trading. And as long as you have fear and greed in any trading entity, which is all investments, candlestick signals are going to work very effectively for you. Let's see. I'm about to order your video, but I'd like to know what % of it is explaining the history and basics. Oh, Mike, very little on this one. This is again the advanced, a little bit more advanced, showing the targets. We have videos. Again, we have 40 or 50 videos out there right now showing the 12 major signals, showing the patterns, entry and exit strategies, scans, stop losses, how to take profits using candlestick signals. Essentially what candlesticks did for me and should do for everybody is, because the probabilities are there all the time, and essentially once you get accustomed to candlesticks, it takes your emotions out of your trading. It allows you to start buying at the bottom when everybody's telling you how terrible things are, or taking profits at the top when everything looks rosy. No, that would be a different scan. And that's another part of our membership, is we usually do a training session every Monday night for members, showing what the markets are doing, what the commodities, currencies, everything's doing, which signals and patterns work the best. And then we go for another hour after I do my hour of people asking about their individual stocks so that they can constantly learn what patterns are occurring. We do that free every Monday or every Thursday night. Everybody's allowed to come in at that night. And then during the week, usually about once a week, instead of having to buy the video for scans or stop losses, we do that live for an hour so that people that are trying to learn let's say, how to scan for the best trades, they don't have to just be watching a video. They can be watching how to do it live. That way they can be asking their questions right immediately. So that's part of the $97 a month that you probably get $200-300 of video training for free during the month. Details again on your commodity trading. You use a 10-minute chart to trade, and entries and exits are the 5-minute, 1-minute, or 5 or 2-minute charts. If I'm buying a commodity, like we started buying crude oil today when it bottomed out, I'll trade off the 10-minute chart. But once my 10-minute chart starts showing that there's a reversal in progress, then I flip down to my 5-minute chart to make sure that my 10-minute chart is still performing like it should be. And then if I'm ready to enter a trade, I'll immediately flip to the 1-minute chart, because what I don't want to see on the 1-minute chart is that we're up in the overbought condition on the 1-minute chart and it's ready to pull back, because if it's ready to pull back, that means my 5-minute and my 10-minute chart aren't going to be confirming. So, but if I look at my 1-minute chart, and let's say my 1-minute chart just did a J-hook pattern and it's heading back up, which means my 10-minute will be heading back up, that becomes a good entry point. And we do, again, that's part of our training. And this is, again, there's nothing difficult about any of this. Once you understand what chart patterns and what signals work, now you can put them into whatever time frame. I used to trade the E-minis on a 1-minute, 3-minute, 10-minute chart combination. I trade soybeans, the dollar, cattle, hogs, cotton off the 10-minute chart right now. And I usually trade, I don't intentionally day trade, but if I've got good profits in a trade during the day, I'm going to take them. But I'll trade the commodities just like trade the stocks, which is usually a swing trade, because I want to catch the whole trend, or as much of the trend as possible. Okay, Steve, thank you again for the invite today, and thank you everybody for staying this long. I know I've got everybody way over time. Clicking on the Carlo, if you're having problems getting the Steve just put in the link again, or email Abraham at Candlestick Forum, and you'll make sure you get in or get everything set up properly. All right, thank you everybody. Steve, thank you for the invite. We'll hopefully see everybody in the chat rooms.
Thank you very much, Steve, and thank you everyone for attending today. As you see there in your chat box, there is the link posted by Pro Trader Strategies. Simply click that on. It will take you to the special offer that Steve has. Also, if you want to get a link to a recording of this presentation, you can, but remember to hurry up and take advantage of that special offer that Steve had presented today. Thank you so much for attending today. We'll see you next time. Bye-bye.